Hello, and thank you for joining us in our experiment. And I'm going to be doing a short review of variance analysis for you. Dr. Villano has probably covered these in some of the classes, more in depth for the students in class 3711 versus those in 2603. So what is a variance? A variance is the difference between a budgeted and actual amount, okay? It can be favorable, it could be unfavorable. Now let me just give you a simple example. Let's say you budgeted $250 for your books and you spent $350. So if you budget $250 and you spent $350, that is a $100 unfavorable variance. So I have this little chart that shows you that the book expense actual was $350, the budget was $250, and there is a $100 unfavorable variance. The U means unfavorable. The parentheses also mean it's a negative unfavorable variance. So let's look at another example. What would your budget look like if you were expecting $15,000 in scholarships but got $15,100? So let's look at this. The actual scholarships were $15,100. You're expecting $15,000. Well, that is a $100 favorable variance. Okay, so that's good news. Variances can be represented several ways in managerial accounting. So here's a financial statement. We see actual operating income and the master budget. So the master budget is what they think will happen this year. But if we look at the actual versus the master, we will see that the number of units we had planned to sell, we thought we'd sell 1,000, but we sold 780. That's a $220 unfavorable variance. If we look at sales, we thought we would get 800,000, but we got 639,600. That is a 160,400 unfavorable variance. Once again, you see parentheses and you see a U, showing you that that is unfavorable. When it comes to variable costs, what happened here was because our sales went down, our variable costs went down. That makes sense, right? And so our variable costs went down from 450 to 350,950, and guess what? That's a favorable variance. So when we work through the financial statement, you will see these differences, and overall they had a $72,000 unfavorable variance for that year. So there's something else called a flexible budget, and a flexible budget flexes based on number of units. So here's another diagram. Here's actual sales. Here's a flexible budget based on selling 780 units. And then this is compared to the master budget of what they expected for selling 1,000 units. Now we're not going to dig in, but I just want to show you there's a master budget variance, there's a flexible budget variance, and a sales volume variance. But again, you don't need to know that much detail. I'm just still trying to show you we have favorable variances, unfavorable variances. Now let's spend a little time and talk about manufacturing expenses. Okay, manufacturing firms make things, and they have three types of expenses. We have direct materials. Those are the materials that go into making the product. We have direct labor. That's the labor that goes into making the product. And we have factory overhead. That's everything else that went into making the product. That can't be directly traced to the product because it might be some screws, it might be some glue, it could be some other expenses on the factory, and things like that. But you probably learned about that in class. So manufacturing costs equal direct materials plus direct labor plus factory overhead. And so we can have variances in direct materials, we can have variances in direct labor, and we can have variances in factory overhead. So we have direct material variances, we have direct labor variances, and we have overhead variances. We're not going to dig into that much detail, but I just want you to know what those types of expenses are. So one important note, and this is for your group, is that sometimes there are variances, but they might be manipulated and misunderstood due to something called mental accounting. Now, you will be watching an entire video on mental accounting, It lasts about 12 minutes where I get into depth. But let me just introduce you to this concept. So let's say this company has a direct labor variance of 0, a direct material variance of 200,000, favorable, and that gives us a favorable variance of 200,000. Okay, overall, 0 plus 200,000 gives us a total variance of 200,000. Now, look at this. We still have a 200,000 favorable variance, but in this case, we have 100,000 for direct materials, we have 100,000 for direct labor. And which would you prefer? Mental accounting says you will react differently to this versus this. But the truth of the matter is, there isn't really a difference, is there? Okay, the breakdown, there is a difference, and we may want to look into it. But someone could manipulate numbers to have you, like, instead of noticing this, they might put it down like this, and it's less noticeable. Even more so with a loss, for heaven's sakes. You have 0 unfavorable variance. You have 200,000 here, 200,000 unfavorable variance, but here it's broken down in smaller pieces. So again, we don't know exactly, which is real, but accountants might manipulate these numbers so that you will not notice certain things. And so that's what I'm trying to point out to you, that a variance is a variance. A 200,000 variance is a 200,000 variance, no matter how it breaks down. Now, that could be the true breakdown, but it might not be. It might have been manipulated. Okay, so a variance is a variance. Don't be fooled by how they show up on your, let's say, your financial statement. And we hope to see you in the lab. And now you can watch our video on mental accounting. Thank you.